Hi everyone, it's Chad back with another video. Today I'm going to be talking about a company that's known to many people, pretty much every investor. That's Alphabet, parent company of Google, of YouTube, of Google Cloud Platform, all the other bets. This, of course, has been a fabulous company to own over pretty much any period of time other than the last year, where it's down nearly 30% year to date. If you've held on since the IPO, it's over 30x. Fabulous company, really completely owns search. YouTube, until the rise of TikTok, has completely owned video, and it's making gains as the third player in the cloud space. Of course, it's a fabulous company. It's now a $1.3 trillion company. Is the value to be had here? It's a PE ratio of around 18 or 19 as we speak, way off its 52-week high of $151. Right near that low, as I said, down 30% year to date. Is the value to be had here? And is the potential for growth in the future of this company at $1.3 trillion? How much growth can we be expecting from this business? The vast majority of YouTube's business, or its free cash flow, is search. And search is essentially a cash machine. Free cash flow for 2021 for the whole company was $67 billion. That is absolutely ridiculous, one of the highest numbers you will likely see. And that has provided it with a fortress-like balance sheet. As of June 2022, nearly $125 billion in cash on the balance sheet, and that's actually down from late last year because they've been buying back shares. And debt around $29 billion, which, to be honest, is pretty negligible for a company of this size. $29 billion in debt for a $1.3 trillion company is next to nothing. Cash debt ratio 4.35. It's coming down versus its history because it's taking on a little more debt and having a little less cash than it's had over the last 2 years. But I'm not concerned about that whatsoever. This debt compared to its EBIT is absolutely minuscule, as shown by a 229 interest coverage, meaning with this year's EBIT it could pay 229 years of interest. So absolutely no concern here, as indicated by a given Altman score around 10.5, showing this company is safe from near-term financial distress. A fortress-like balance sheet like this is provided by excellent free cash flow, meaning Google can buy back shares at a regular basis. The share count is coming down gradually. They do have a lot of stock-based compensation because of the nature of this business, but slowly because of the sheer numbers, the share buyback authorizations they're doing in the 50 billion range yearly, and these are coming down over time. Also, with a balance sheet like this, Google has the potential to fund its other bets over the long term, and they're happy for them to be unprofitable, to invest in Google Cloud Platform, and also to be an acquirer. Both Maps and Android, for example, both came from acquisitions. Google has a very strong track history in the acquisition segment. We'll have to see how that plays out because there's obviously regulatory concerns. But many companies, one being Pinterest, for an example, I've heard rumours of recently that they will be looking at acquiring Pinterest because they could do it in cash on the balance sheet, no problem, and have plenty left over. From a valuation point of view, a company like Google should always carry a relative premium valuation because it has excellent margins. While these gross margins of 56-57% are not SaaS gross margins of 80-90%, whatever, these are fabulous gross margins which they convert really well to strong operating and net margins. And nearly 30% operating margin is absolutely excellent for any industry and very strong for Google's history. A company that does this, along with a return on equity percentage of 29%, return on assets of 20%, and return on invested capital of 35%, will of course carry a price earnings premium over the market. At the minute, it's a PE ratio of 19 on a trailing basis, around 17 on a forward basis, both of which are a slight premium to the S&P 500 right now. However, it has a PEG ratio of 0.71, which is possibly bargain territory, really. Under 1 I would consider bargain territory, and this is particularly low for Google's historical valuation. Has a price of free cash flow of around 20, which is kind of the upper limit for what I would deem acceptable. I think below 20 is reasonably fair value, not a bargain by any means, but reasonable. I think a lot of these valuation metrics are telling us that Google is okay value. It's not an absolute steal by any means, but this is cheaper than it has been a lot of the time because it normally trades for a significant premium to the S&P 500 in the above 20 PE range. Next, using a bit more of an advanced valuation technique, that of course being the discount cash flow analysis, to work out a fair valuation for this stock based off of some of its future cash flows. Using a 9% discount rate for the long-term returns of the stock market, this company will need to grow its free cash flow around 12% on a compound annual basis for the next 10 years to provide fair value at today's price. Now, is that possible? Yes, I believe it is. Over the last 10 years, they've grew the free cash flow 14%. Already very, very large numbers earlier on. Over the last 5 years, they've grown at 22.3% on average. And in the last 1 year, 13.4% on average. Now, I don't think this is an absolutely conservative case. I think a more conservative case would be between 5 and 10% perhaps. But Google has a lot of mega trends that it is riding. YouTube is really coming to its own recently. They, of course, have Google Search, which is the most powerful and widely used search engine in the world. It doesn't seem to be slowing down anytime soon. Advertising moving online is only happening faster as of late. And of course, they have Google Cloud, which is only eating money really at this point. It's producing revenue, but it's eating a lot of cash. This will become a huge free cash flow generator for the company Google Cloud over the longer term. And of course, they only need to really succeed on maybe one or two of the other bets over the long term to be fantastic compounders over the long term. For example, if Waymo, the self-driving platform, managed to figure out and crack self-driving, then that could be a ridiculous compounder over the long term. There's a lot of potential for this company. I think perhaps if you want to be more conservative and put the rate, say 8%, then this is not absolutely fair value right now, and you'll probably want the stock to drop a little bit more. But I think 12% is fairly reasonable. That gives a fair valuation of $106 compared to a present day stock price of around $100. It's not an incredible premium, but a decent one. One thing that's frequently held against Google as a business is that advertising, which is the vast majority of this company's business and is the most material thing to it, is a cyclical industry. As we potentially head into a recession in late 2022, maybe 2023, then advertising being a cyclical industry is going to suffer, and Google's revenues and therefore free cash flow and therefore valuation will suffer. So far, we're not really seeing this. While they experienced 62% revenue growth from 2020 to 2021 for this quarter and only 13% this year. That's still decent given today's environment. Of course, that is an absolute aberration of a year 2020 to 2021. While we're seeing a massive decrease in growth, this is still not a company that is X growth. And you're talking, 17 times forward earnings for a company that's growing 14% with 30% operating margin and a lot of growth potential. I think that is fairly reasonably valued. Of course, when it was growing 60%, it was probably pretty undervalued, and a lot of people picked up on this and will have made decent returns since. But for 28% operating margin at 13% growth, with still a lot of potential in the tank and tons of cash for a balance sheet, I think this is fairly reasonable. So I'm not really seeing the risk here over the long term. This is definitely a business that isn't X growth, has a lot of potential for the future. As I mentioned, while this is still predominantly an advertising business, you've got to notice that Google Cloud's revenue grew over 30% year over year, and this is quickly becoming quite a large revenue gainer for this company. $6.2 billion in revenue for Q2 2022. On a yearly run rate, that's going to be $25 billion in revenue. While it's not the market leader right now, it's still gaining at a really strong rate, not growing quite as fast as Azure or AWS and coming off much smaller numbers, but it's getting there, and they're putting a lot of investment into this. So while they made an $858 million loss, they're still making significant revenue gains, and this is really important for the future of this business. And as a standalone company, this would be probably a $100 billion company in its own right. So I think it is massively overblown the future growth prospects of this business. I think it has fantastic growth prospects going forward, and even if it just maintains how it does, even if advertising was the only business here, I still think this would be a fantastic company. So I don't need to continue to espouse the benefits of why Alphabet is a fantastic company. Most people know that this business is a fantastic company. It's been an excellent compounder over the long term. The question is now, is it reasonably valued right now? I think, yeah, it probably is. I don't think we're going to see Alphabet go much cheaper because it's such a safe haven. It has around 10% of its market cap in cash right now, and it could deploy this at any moment to buy a smaller company or to continue to buy back its own shares. Its Google search is an absolute money printer, and it is going to continue to be a cash machine over the long term, in my opinion. It doesn't really have any competition. The only extrinsic pressures for this company, I believe, are regulators, whether they cause it to break or spin off YouTube in the future, for example, or spin off Google Cloud Platform, which I can't really see happening and definitely won't happen in the short term. So as far as I can see, I think this is an absolutely excellent company, trading at a reasonable valuation. I'm going to continue to add to my position in Google, and I'm going to be adding quite significantly if it continues to trade at PE under 20. I don't think we're going to see this for much longer. Of course, that's just my opinion. You let me know what you think. None of this is financial advice. You should do what you think. Do your own research and due diligence. Not just buy something because I'm buying it. Let me know what you think in the comments down below. Like and subscribe if you enjoyed the video. See you again next time.